You ever get the feeling that the financial markets are talking? Like there's a hidden language, these little clues that can signal what might happen next? Well, today, we're going to peel back a layer and look for exactly that. These tiny but super powerful signals that traders call cracks in the market.
Okay, think about it like this. Picture two dancers, right? They're moving perfectly in sync. Then, just for a split second, one of them misses a step. You'd notice that immediately, wouldn't you? Of course. The same thing happens in the markets. So what on earth does it mean when two markets that are supposed to move together, say like the NASDAQ and the S&P 500, suddenly don't? That's the big question we're diving into.
And that brings us to the main event, smart money time, or SMT for short. It's literally that missed dance step we were just talking about. It's a crack in the correlation. So when two markets that are basically joined at the hip suddenly start going their separate ways, that's a huge sign. It tells you the real momentum, the actual buying and selling pressure, it might be about to change. It's this tiny hint that, hey, a reversal could be just around the corner.
Okay, hold on. Before we get any deeper, I need to make one thing absolutely clear. This is the #1 rule, and trust me, we're going to repeat it. SMT is not a crystal ball. It doesn't predict the future. It's not some magic signal that tells you, hey, buy now, sell now. No way. The key thing to get is it's a confirmation tool. It's there to confirm an idea you already have about where the market is headed.
All right, so how do you actually see these cracks in the wild? It really boils down to two classic patterns. Let's break down exactly what traders are looking for on the charts. So you've got two flavors here. First, there's the bearish SMT. Think of this as a big ol' warning sign that an upward trend might be losing its juice. And then you've got its opposite, the bullish SMT. That's more of a hopeful signal, suggesting a downward trend might finally be hitting the brakes. Let's take a look at both. Okay, let's start with the bearish pattern. Imagine two markets both climbing higher. Market number 2 pushes on up and makes a brand new higher high. Awesome. But, and this is the key, at the exact same time, market number 1 tries, but it can't quite make it. It only manages to make a lower high. That, right there, that's the crack. It's this subtle little hint of weakness, telling you the upward push might be running out of steam. And the bullish pattern? Well, it's just the exact opposite. So now picture both markets falling. Market 2 drops and makes a new lower low, but check this out. Market 1, it digs in its heels. It refuses to go that low. Instead, it forms a higher low. See that? That little split, that divergence, suggests there are buyers stepping in under the surface. It's a hint that a bottom could be just around the corner. Now, here's where it gets really interesting. This whole thing isn't just about price. Timing is everything. These patterns become way more powerful when you look at them through the lens of market time cycles. Let's add this next layer to the puzzle.
What's so cool about S&T is that it's fractal. What does that mean? It means the exact same patterns we just talked about show up on every single time scale you can imagine. You can see these cracks on a monthly chart, a weekly chart, a daily one, heck, even a 10-minute chart. The logic, the core idea, is identical no matter how much you zoom in or out.
So, how do you actually use this with time? It's a pretty simple 4-step process. First, you just find the high or the low from the last cycle. Let's say yesterday's high. Easy enough. Second, you wait for the new cycle to start. Third, you watch to see if one of the markets takes out that old high. And here's the magic. Step 4. You check to see if its partner fails to do the same thing. That failure, that's your time-based SMT. Okay, so we've got the basics down. Now let's level up. We're going to look at some more advanced and honestly more subtle versions of SMT. And this is called open price SMT. So here, the divergence isn't about breaking old highs or lows. It's all about how the markets react to a key starting price, like the day's opening price. So for example, one market might drop, tag that opening price perfectly, and then bounce, while its buddy gets close but doesn't quite make it. It's that tiny difference in how they react to that level that's the signal. And listen, this isn't some small-time variation. The source material flat out calls this specific pattern a key warning sign. It suggests a pretty big pullback in price. What traders call a deep retracement could be on its way. It's one of those signals that makes you sit up and pay very close attention. These ideas can also stack on top of each other. That's when you get something called a double SMT. This is when you find a tiny little SMT, say on a 10-minute chart, that's happening right inside a much bigger SMT pattern, like one from the daily chart. It's like a signal inside a signal. And for traders, that's a much, much stronger confirmation.
All right, we've gone through the classic patterns, we've touched on the advanced signals, so let's wrap this all up. What does all of this actually mean when you're looking at a chart?
This is a perfect little summary right here. You've got your classic SMT. That's all about pure price divergence. Then time cycle SMT adds that crucial element of time. Open price SMT zeroes in on a specific key price level. And finally, double SMT, that's all about that powerful layered confirmation. They're all just slightly different ways of seeing the same thing, a crack in that correlation.
So after all that talk about patterns and time frames and levels, it really all comes down to just one single rule. The absolute most important takeaway from everything we've talked about. We said it at the beginning, and we're going to say it again at the end because it's that important. SMT is merely a confirmation tool. It's not a strategy on its own. It's not a magic bullet. It's simply and powerfully there to confirm what you already think.
So, what do we really mean by confirmation? It means you've already done your homework. You already have an idea, an analysis, that says, hey, I think the market is about to turn here. SMT then comes in as that last little piece of the puzzle. It's that final nod that says, yep, your analysis might be on the money, and the timing could be right for things to shift.
And that kind of leaves us with one last thing to think about. We've just looked at one, single, hidden pattern in the financial markets. So if these markets, which look so chaotic on the surface, have these subtle, almost invisible cracks, it really makes you wonder, right? How many other unseen patterns are out there, quietly shaping the world all around us?